Over the last few weeks, or actually a few months, is it as the corona epidemic spread along throughout the world, I was thinking about how to screen for good investments in the current environment, because company profits are going to be lower. There's going to be a lot of zombie companies, and with zombie companies, I mean companies where they're only earning enough cash or profit to pay the interest on their debt, but they can't really invest in the business, or they can't really pay the debt back. The banks are lenient because they don't want to let the companies fall over, and the governments are giving them bailouts. So these will probably not be good investments. These are companies you want to avoid. And you want to find companies that will be able to survive and not value traps, right? With a value trap, you're basically talking about a business that keeps on declining and eventually goes out of business or has to change their business substantially in order to be profitable or survive. You can think of good examples were Nokia in the past, and BlackBerry also another one. GE was also probably one that I didn't expect at all. And how to use a screener to help you do all of this. It's Warren Buffett. As I was thinking about all of this, it reminded me of a quote that Warren Buffett said, in order to make money in the market, first of all, you must survive with your capital in place, I would add to that. And also, how do you avoid overvalued markets like the US market at the moment, I imagine, right? You can see there's obviously extreme bubbles going on in companies like Tesla, and obviously you want to avoid investments like that. And then if we have a little bit more time, then I'm probably going to talk about a few alternatives that I've thought about for investing in bonds, or rather not bonds, but give you a similar kind of income approach. Anyway, so let me start with a screen that I've saved for you. So I'll just go to the screener, load the screen. Let me first talk about how the screen is set up. The first ratio I'm going to use is called the gross margin marks ratio. It's basically gross profits over total assets. And this is the only quality ratio that we really, in all our testing, have found that really adds a lot of value. And you can see that I'm setting the slider at 50%. So basically, I want to screen out the bottom 50% of companies with a low gross margin, according to Professor Novi Marks, which developed the ratio. The next one, I'm going to screen out the bottom 50% of companies with the highest debt to equity ratios. So I'm going to select those with the lowest. And then to not just make sure that a company's got low debt, but it can also service their debt, I'm choosing to only select the top 50% of companies with a good free cash flow to debt ratio. In other words, this business is generating free cash flow that it can use to pay back debt. And then external finance, this is a ratio that's quite interesting. It tells you if a business is able to finance the growth in assets from internally generated cash. In other words, if a company's total assets increased by 10 million, did the business generate 10 million or more cash in the last year in order to finance that growth? So it didn't have to go and take on debt or anything like that. And again, I'm screening out the bottom 50% of companies that cannot finance it. These are all strong cash generating businesses that can finance their own growth. So now you already cut out the universe of 50% of all the companies on all these ratios. I put a daily traded value volume of there, and I didn't put a market value because the daily traded value, I find, screens out most of the low companies that don't trade anything at all. And if you look at the results, you see this is a whole list of companies that the screener came up with. But now the question is, these companies all have, you'll see, the latest financial dates is mainly 3/4 of this year. So you have the last trailing 12 months. So you have 3/4 of this year and then 1/4 of last year. So now you want to see, okay, companies have declined in profitability, but you want to find companies that have still been well profitable in the past. And you can do this. I included these two ratios here: earnings yield 5-year average. That is the 5-year average EBIT of the company divided by its current enterprise value, and this is the 5-year average free cash flow divided by the enterprise value of the company. And the nice thing about the columns is you can also screen in these columns. For example, you can say, let's say we're looking for an earnings yield, 5-year average earnings yield of better than 12%. We can say 0.12. Oh, wait a minute. And then we just say greater than or greater than and equal to. And then say we want a free cash flow yield of more than 8%. Let me just say greater than. So now you have a lot of companies that are profitable or have been over the past few years, but now you obviously want to make sure that you're not selecting value traps. And in order to screen those companies out, I selected this momentum indicator. You can always look for the definition of all the ratios and indicators by clicking on the online glossary. It'll take you to the glossary here, and here you can quickly find out what the adjusted slope is or whatever, how all these ratios are calculated. So getting back to the screener, if you want to sort the column, you can click on the column heading, and first it'll sort from low to high, and this is obviously not what we want. We don't want companies that have fallen the most over the past year, or average of a year and a half. We want companies that have increased the most over the past few years. And here you can see you start getting a lot of companies. And funny enough, if you select these ratios, these companies all have a good QI value ratio. With QI value, the same as value composite 1, I'm sure you'll remember, the lower the ratio is, the better. And here you can start slowly looking for ideas. So Moto, this company I've never heard of. Manning & Napier, I looked at it. It's a company, and I think an asset manager in the US, but it's got an obscure capital structure. Pax Global Technology, that is a payment point Android device manufacturer in Hong Kong, which we selected for the newsletter and has performed extremely well so far this year. The other companies, I don't know, those subscribers of yours in the newsletter, you'll see there's a lot of companies. Toshiba is another one we recommended in the newsletter. And then as you go down, you'll see that the quality of the companies are quite good, and even they are even cheap, even if their profits were lower over the last 12 months than it was previously. So this is one way you can look at companies, and this way you'll find companies that have maybe been low in profit, but have been wildly profitable in the past. And because you're looking at momentum, you're screening out companies where the stock price is just going down all the time, where the business is failing. I have a question here from somebody saying, why is momentum a good value trap filter? Well, if a company's business is failing, it's unlikely that investors would be buying more of the company. So, supply and demand, pushing up the share price. So that way, if you screen away for companies, let's just look at the inverse of this and see what kind of companies are coming up. Okay, these companies are not, there's a pulp company in Canada, and I think that pulp prices are at record low. Here's a few petroleum businesses. So you can look at those ones. Here's a few asset manager business, value asset managers, and you can see that they've been battling like hell to keep their assets under management. So you generally see companies that are failing, have a falling stock price, or at least are in the low part of the momentum curve, you can say. And if you screen for companies with good momentum, these companies are obviously profitable and have good prospects, because Pax, I think, recently put out a profit warning, but positive one, not a negative one. I think they say that they said that their earnings is going to be 40% higher this year, just because everybody's been buying cashless payment terminals. So that's a way to do that. I'm just reading another question. Would a high dividend yield be a good value trap filter? I don't know. If you think about what Shell did, their business was declining, the oil price was falling through the floor, but they still kept their dividend, even though it pushed up their borrowing substantially. But I think everybody was worried that Shell was going to cut their dividend by at least 50%. I think they did in the end. but the stock price still went down. So I don't think a high dividend yield is one. Maybe if you could find a company where it's a high dividend yield, but it's got a high dividend cover, because I think Shell had a dividend cover of less than 1. I think it was 0.5% or 50%. In other words, they only generated 50% of profits and they paid out 100 in dividends. So I wouldn't say that that's a good value trap filter. Yeah, momentum is a good one. And then obviously, if you used these ratios that I explained, a company that's a value trap where the business is declining, it's unlikely that it'll have high margins. So that was the one way I was looking at finding ideas in the current environment. And but let's take another look at another screen that I set up. Always when you're going to run a new screen, always reset all the columns and the screener variables that you may. Yeah, that's where you make sure that there's nothing from the previous screen that gets carried over into the next one. This screen is more of a classic one, and newsletter subscribers would recognize it immediately. It's basically the top QI value companies. We use adjusted slope where we screen out the bottom 60% of companies, and we want companies with a healthy Petrovsky F-score. Now you can say that a Petrovsky F-score, the best Petrovsky F-score is between 8, 9, and maybe 7. But if you look at the original Petrovsky score that that Professor Petrovsky developed, he basically looked at, or rather, if you looked at companies with a 0 or 1 Petrovsky F-score, those are companies you really want to avoid. And remember, because of the COVID problems that the companies have had, a few of those Petrovsky F-score values would deteriorate. For example, if profits declined, or I think, for the life of me, I can't remember what the other 8 indicators are, but there's a lot of indicators saying that the company must have increasing profits, not increasing shares issued, and factors like that. So I think being a little bit more lenient on a Petrovsky F-score basis would be fair in the current environment. I see there's another question. Oh, there's just a question, Tim, can you explain the crucial difference between the crash portfolio compared to your classic screens? Compared to the classic screens, we still look at companies' current profitability. But if you look at the crash screen, there we look firstly at completely solid companies financially with those 4 ratios that I explained. And only then do we start looking for companies that or do we start looking at valuation or at their profitability in terms of earnings yield or free cash flow generation in the past? So it's a bit of a different approach. For the newsletter companies, we still look at companies that are still profitable and cheap. And then the other one, we're first looking at companies that will survive. And then from those, we're looking at cheap companies. So looking at, okay, here's the screener. They still have the 80,000 volume per day average. I make sure that the financials have been updated in the last 9 months, but usually I look at the last quarter must be updated. You can see them here. There's one that hasn't been updated for a while. That's also a company recommended in the newsletter. It's a Singaporean company, but they haven't updated their September results yet. And there's a few sectors that I exclude. I exclude mining companies and biotech companies because I find that those are completely difficult to say. It's more of a binary outcome. Is this biotech company successful or not? And I don't want to invest in companies like that. And now you can take 2 approaches in terms of these companies. You can either sort by QI value from low to high and then start looking through the companies. Just in case you forgot, if you click on the company name, let's just find one. Here's one that we recommend in the newsletter. It's a Canadian company. And if you go to the dashboard, you can quickly see a lot of, if you don't want to do a quick research on the company, you can see that current share price, it's got a market value of 180 million US dollars. Traded share value is about 348,000 over the last 30 days. These little indicators show you what that means. Here's the sector that it operates in. It's got a Petrovsky S score of 9, really good. Okay, the Altman Z score is not so good. The Monty Cook in the book score is quite low. It's got relatively high debt to equity, and the free cash flow to debt also looks okay. The gross margin marks is very good, 33.4%. Here you can see what the sales did over the 1 year and over 5 years. Sales, EBIT, free cash flow did, and the dividend yield over the period. Here you can look at valuation, price to book, price to earnings, EBITDA yield, the earnings yield, free cash flow yield. It gives you a good indicator. Here's some of the composite value indicators. And here you can see momentum. Stock price is up 39% over the past month. Over 6 months, it's up 73%. Over 12 months, 69, and over 24 months, you can see it really took a knock from COVID and it hasn't quite recovered. And here you can see where it is on the screen, just in terms of all these variables, and you can select different variables here if you would like to. Let's see value composite 1. And here's a 12-month chart. Here you see what the stock price has done in the last period. I think it's mainly because of vaccines, where this company owns a lot of hospitals. So obviously with the vaccines, people will start going for elective surgery again so the company can recover. But I mean, look at it. The company's stock price has been 18 and it's only just below 8. Anyway, so once you've got a good indication of what the company looks like, you can quickly go back to the screen and then it'll show you exactly what other companies are on the screen. Let me see if there's any questions. What is market value at 0? That's I don't quite understand the question. Were you referring to? Oh, okay. I think Philip, I think I didn't put a market value indicator in the screener. That's just because I say that if a company trades $80,000 or euros in shares or value per day, it automatically select large enough companies. So I don't want to put a market cap value in the screen there. Anyway, so this is, you can either, just getting back to my previous point, you can either select the cheapest companies in terms of QI value, but obviously then you're only selecting in terms of value. What I'd also like doing is saying that I want to have a QI value of less than 7, which means the company is really well rated in terms of QI value. But then let's just drag this column across so we can see it over here. I want to select companies with a good, while being cheap in terms of QI value, I want to select companies with a good momentum, again, to avoid value traps, or select companies that have been doing extremely well. Obviously, if you do that, you're going to get companies that have had extreme success and gone up a lot over the last, let me just see if I've got a price index here. Here you can see. Over the past 6 months, the price index is the current price divided by the price 6 months ago. So this company did extremely well. These companies all did extremely well. But here you can see Union Gas Holdings. This one did extremely well, the one we recommended for the newsletter, and some of the other ones. So in this one, you can see that you've got cheap companies because you obviously selected some of the cheapest in terms of QI value, but you're also selecting companies with good momentum. And that's another way you can also approach it. Either just by value, then you're completely ignoring momentum, although you're not completely ignoring it, because remember, you already put a filter in here that you're screening out the bottom 60% of companies with bad momentum in terms of the adjusted slope factor. So it all depends on what your approach is. If you're more of a value investor, you would probably sort by QI value, or if you can of course select value composite 2 as well. If you just select a value composite 2, you're obviously getting companies very cheap in terms of value composite, but then their adjusted slope ratings will not be as high, or they won't have as high momentum as the ones you selected, for example, if you said QI value. But remember, just me showing you that you must remember to remove this this filter, because otherwise you're still going to have this filter on QI value if you sort it by this column. So just be careful for something like that in the screener, because it may skew your results. And as you know, if you add value composite 2, you're going to have a price to book value in there, and here you start seeing all the Japanese companies, right? You can see them all. Japan, really, really cheap companies in Japan, and a lot of these have also been recommended, not these specifically, but a few of those have been recommended in the newsletter as well. Anyway, are there, oh, let's see, there's more questions. Philip asked another question. He asked about moving averages. Yeah, this is a new indicator that we included in the screener. I think I wrote to you about 2 or 3 months ago about it. And you can add it over here. It says simple moving average. And let's see what it says. Add a column with a simple to the number of add a column with a simple moving average for the number of past closing price prices. Note that adding this column might lower the screener performance. Oh, the screener is a calculator, it's a simple moving average that you add in here, because obviously you can put in any number, right? 50, 200, 159 days, whatever. So the screener has to calculate it. So it may be a little bit slower. So let's say we want to look for companies that are trading above their 200-day simple moving average. You can enter it over here, and then you just click apply. You'll see the screener is a little bit slower because it has to calculate all those values. And you'll see, I've just got to find it. The columns are a little bit too wide here. You'll see the screener automatically adds a simple moving average column there to the results of the screener. And what this indicator means is that if the current stock price is above the 200-day simple moving average, then, this indicator is calculated as the current stock price divided by the 200-day simple moving average. So if this value is above 1, it means that this company is trading above its simple moving average. So let's get back to the example. So you only want to look for companies trading above their simple moving average. You can add a value of 1. And you can just say greater than. Now you will only see companies that are trading above their 200-day simple moving average. And then you can obviously go ahead and sort by QI value. It means that these companies are cheap. They're trading above their simple moving average. And of course, you can combine these numbers as you want to, right? For example, you can say I want QI value, which is less than 7. I want a simple moving average that is above 1. The company's current stock price is above that. But I also want companies with a good, where is, oh, the column slipped over to the right-hand side, I think, again. With a good adjusted slope rating. So you can just, you don't want to sort from high to low. You want to sort from high to low. Yeah, the companies with the best momentum. So these, that's unusual. Oh, I said greater than. I'll change this to less than. So now you're looking at companies that are cheap based on QI value. You're looking at companies that are trading above their 200-day simple moving average. Remember, we added it over here. And because we sorted by adjusted slope from high to low, these companies also have good momentum. This would be a good index. Can you? Javier asked a question, did you analyze Wirecard? How do you avoid these type of companies in the screen? The Wirecard was always quite expensive, yeah, Javier. So you wouldn't have picked it up, and yeah, in the screens because it was just too expensive. But QI value uses free cash flow yield as an indicator, and the problem with Wirecard was because of the fraud. They never they generated accounting profits, but they never generated cash profits because there was fraud. You know, the people. I mean, where did you see a company that's supposed to process payments needs loans of 1.9 billion to fund their operations? I mean, what are they building? They're not building Teslas, right? They're just building maybe some terminals, which are not expensive, and then, you know, for the rest, it's just computers and some software to to collect these payments. So as soon as you use an indicator which is built into the QI value, cash flow yield, companies like that will be screened out automatically. And I think companies like that, I didn't check that. If you look at indicators like, let's just see here. Let's look at Hornbach. If you look at companies like the Montier C score, there you can see it's 1, so it's very good. That's a score that helps you identify companies that are cooking their books. So if you look at indicators like that, you can also obviously include that in the screener. You won't select investments like that. Philip asked a question is if you can group the results by country. Yeah, that's very easy. You just take the country heading and drag it into this block where it says drag the column heading here to group. And as soon as you've done that, you've got countries Austria, Belgium, Canada, Denmark. You know, they're all sorted by country. Here's a question by Frank. Which indicators, combination of 3, would you use to find companies to short, especially in market downturns? Frank, that's a good question. I'm not a guy that's ever shorted companies. No, I didn't actually ever short them. I did sell put options in the financial crisis, and I did quite well with that. But I never looked at shorts. I spoke to a friend of mine who's a good hedge fund manager, and he said shorting, even for him as a hedge fund manager, and he ran his fund for more than 13 years, and he closed up recently. He said it's a lot more difficult than what he thought. But there's an article on the web and in our blog that I wrote, how to find companies to sell short. I think if you look at that article there, 7 ratios to help you find the best companies to sell short. They obviously talk about the Montier cooking the book score. Short interest is another one. So there's a lot of indicators you can use in that. So I haven't really spent a lot of time there because I just find it too difficult to focus in terms of finding companies that are cheap, undervalued, and good quality to change my mindset completely to look at really junk, bad quality companies that will most likely fail or go down. It's just not something that I have done, but there's a lot of indicators you can use to do that. For example, one I would suggest is look for companies with a really low F score, 0 or 1, because those companies have terrible fundamental momentum. So those are definitely companies to avoid. Frank asked a further question. He said, if you can work as a hedge for the portfolio with options. Frank, I'm not sure. Maybe you can just expand. Are you talking about using just a general portfolio hedge, like using options on an index, like the Stock 600 or the S&P 500? Or you're talking about options on specific companies? We'll just wait for Frank to answer that. But then I'll go to some questions that people sent me before that couldn't attend the webinar. And Inaki, I hope I'm pronouncing your name correctly. I think you said you will be able to make it to the webinar. You asked the question of how to invest in the newsletters ideas using interactive brokers. Inaki, I don't have an interactive brokers account, so I can't give you an example of exactly how to do that. But in terms of normal orders, there's an article that I wrote, how to buy and sell illiquid companies. You can also find it on the website, and that gives you a very good example. One thing that I would recommend is that for the stop losses, never put the stop losses into your brokerage account. You know, there's some companies, for example, Pax is one, and the other one, what was it called, that watch company in Hong Kong? They're extremely volatile. I don't know for what reason whatsoever. Companies are doing extremely well. There's nothing that changes on their results. There's no news coming out, but you see 14 to 16% movements in the stock price on a daily basis. I guess that's just the Hong Kong market. And if you leave your trailing stop loss numbers, say, for example, you say a 20% trailing stop loss on Pax Global or whatever, you may just be stopped out of the company. And that's not what you want, right? You want to rather just have the stop loss in your mind. I mean, I have it in a spreadsheet that I follow, because I don't check my prices on a daily basis, and when I update them, I have a little indicator programmed in Excel. If the company drops more than 20% from the all-time high, then this little value goes red, and I know that this company's triggered its stop loss, and I've got to take a serious look and see what's happened there. Frank expanded on his options. He says no options on these companies, filtered out as failure. Frank, you know, if you want to buy options, I guess instead of shorting, I guess that's what you mean, buy put options on them. I haven't really looked at that. And sometimes a lot of these companies are so small that you won't find options on them. And usually, if you look at large companies that are going down substantially, you know, that's all old news in the market. So maybe you won't find any options, or if you do, they'll be very expensive, because the company stock price is obviously quite volatile, and that'll add to the option price. Frank also asked, wouldn't it be wise to use any of your composite indicators to combine with a stop loss strategy? Frank, I recommend that you follow a stop loss strategy on all the companies, right? Especially if you invest in companies with strong momentum, because remember, momentum can turn quite suddenly, you know, as people have pushed the stock price up maybe too far, and it turns down substantially. Yes, you wrote in the question 15 to 20%. That's exactly what was recommended in the research that I studied on stop losses. If you're a little bit more risk averse, I would say 15%, or otherwise just use 20%. Can you backtest this? Oh, Frank, that's a good question. Backtesting something with a stop loss is extremely difficult. What you can do is, you know, there's a backtesting function within the screener, and you can do that. You can just go into the screener and maybe look at the stop loss on a monthly basis, but it'll be very, very spreadsheet intensive, and that's what we found as well. To program something like that into the database that we use to backtest strategies, it's such a lot of work, and I think that's why you also haven't really seen anybody combining a value approach with a stop loss, because it's just so hard to test. Also, you know, as another rule, yeah, generally value investors don't like following a stop loss, because generally they have the idea that if you like the company at 100 and it falls to 75, then you shouldn't like it anymore, even more. I used to do that, and I lost about 12% of my portfolio in 1 year on one company just because I kept on buying, so I don't do that anymore. Just to get back to Inaki's question about the trailing stop loss, and also he asked about orders. How do I invest with limits? For the companies, specifically the smaller ones that we recommend in the newsletter, I do recommend that you put a limit order in, because you know, you never know if your order size is so big that if you put in a market order, you may go 5 or 10% up or down, you know, depending if you're buying or selling, just because there's not that much volume. And you can't really see the volume, because, you know, for us using free information on most of our brokers, you can only see at best the bid ask and then just the volume at that price. So for example, somebody's offering to sell the stock at 21.20, 200 shares, and somebody else is willing to buy at 20 for 400 shares. So you don't really know how deep the market is. Sometimes what I do is I go to the website of the respective stock market. For example, if it's Norway, then I go to the Norwegian stock market, and if you type in the company ticker there, then usually you get a lot of a lot more deeper order information. For example, you'll see there's 4 different prices and the volume at each one. So that obviously makes it easier because you can know where to set your limit in order to execute that trade. But as a general rule, I put a stop loss order or a buying limit order at about no more than 0.5% above the current price. And then I just see if the order is executed. And then if it isn't, then I adjust that over time. I generally try to do all my trades within the day so I don't get hit with the minimum trade or that flat fee trading fee that most of the brokers charges. And then there's a question by Dimitri. He said he looks at the company. He uses a screener, but then if he sees bad news, then he doesn't even buy. Good news, for example, buy recommendations, he buys. And when there's very little news, he's found that it's been very better to buy and invest in companies. And he just asked his questions. First of all, I just want to comment on it. For most of the companies, if you look for undervalued companies using QI value or even value composite 2, you will see that there's definitely going to be bad news in the market on those companies. For example, if you just look at Medical Facilities Corporation, this company here that we recommend in the newsletter, which still looks extremely cheap. There's a lot of negative news about that, right? People have been avoiding hospitals because of COVID. Nobody's been doing elective surgery. A lot of these hospitals have been standing empty, and it's obviously been bad for profit. So there's going to be negative news. But if you use a lot of other factors, like the ones I mentioned, specifically in the crash portfolio, where you want to screen out bad quality companies, you'll avoid a lot of companies like that where the quality is really bad and the company is going downhill. So, I think it's normal to expect that there will be negative news on most of the companies that you find that are completely undervalued. And then he also asked how to avoid value traps. That's something we addressed already. And then he asked about the news on a company. Remember, the screener is always based on past information. So there may be something that happened in the last quarter or so which haven't been reflected in the numbers. Say, for example, a special dividend, a spin-off, sale of a big part of the company's business that may not be in the numbers yet. So before I buy any company that I found on the screener, you can find an article on how I do research on companies for the newsletter in the blog. I do go to the company's news site and I look and see if there's any news there that changed the company's business substantially since the last update in the screener. For example, you can see, for example, this company, is there any news in the last quarter? I probably will even go back to the whole of this year that changed the business substantially. And that is important to really look at. But in terms of negative news on Seeking Alpha or other blogs or whatever, I think that's to be expected, specifically looking for undervalued companies. He also asked another question. He seems that the portfolio is well diversified. He was referring to the newsletter portfolio, specifically the Corona portfolio that we have. And compared to his portfolio, which is 60% of his total portfolio in S&P 500 related companies. Is diversification worth reducing exposure to the biggest stock market in the world? This is US market, and the tailwind that economy and the Fed gives to those companies. Well, the S&P has been basically impossible to beat in terms of the last few years, just because of the large tech companies that have been gone up so substantially, and they profited even more in terms of the bad economy with COVID. But if you're going to stick to the US market, you're going to find overvalued companies, and you're going to buy the cheapest companies if you have a value strategy in the most expensive market in the world. Whereas if you look worldwide, you're going to find the most, or rather the companies that fit your investment strategy the best. For example, if you follow a QI value strategy and you look worldwide, you may find companies in Hong Kong and Singapore, for example, PAX, or even Medical Facilities Corporation in Canada, which much better fits your investment strategy compared to if you only look at one country. There's also this article on home bias that I wrote, and you'll find in the blog, if you just go to search on the website, home bias, you'll find it is that people, and me included, feel safer investing in the countries that you know well. For example, you have the SEC in the USA that you think, okay, does a good job at looking at the companies, does decent reporting, and no funny business happens there. And that's why a lot of people feel very comfortable working there. Also, there's a lot of data on US companies, which makes it easy to find a lot of information on them. But the problem is, because there's a lot of data, is that people are using this data to make investment decisions. So it means that, those companies are well researched, a lot of writing, so there's a lot of investors picking over those companies, and the prices have been bid up for the companies that are really doing well or that were undervalued. And if they're undervalued, then you can be pretty sure that it's a failing business. Let's just see if there's any more questions. There's a question here. What screen would you prefer now, assuming you were a conservative investor, the crash portfolio or your classic one? I would prefer both, actually, and I would select investment ideas from both, because remember, if you're looking at companies that have good momentum, are undervalued, and are quality companies, it means these companies remain profitable throughout the whole Corona problem period economy. But also, on the other hand, if you look at companies that have really solid balance sheets that may have been hit by the Corona pandemic, but over the last 5 years, their earnings yield or their free cash flow yield was high, those will also give you some very, very interesting ideas. And as you saw, compared to both these screens, as a friend of mine said, that a lot of roads lead to Rome, right? You'll look at those two different screens, which have a completely different approach, but you'll find a lot of the same companies in there. So I would say that both of those are good screens to use to find good quality companies in the current environment. For the one, you're looking at companies that may have been hit, and the other one, you look at companies that weren't hit as badly, but still have momentum, good businesses, and are undervalued. Here's another question by Frank. You backtest different indicators combining value with 6 months momentum. Did you ever compare backtest on 3 or 6 months momentum to have a cheaper, better entry point? Yes, we did, Frank. But the problem is, as soon as you start looking at 3 or 6 months momentum, you should remember that you're trading a lot more. And if your trading costs are not extremely low, even if you pay 0.1% commission, those commissions start really eating into your investment returns. We did find that 6 month rebalancing adds a little bit. I think it was something like 1.3% or something like that. I can't remember if it was per year. So that may have been better, but we just thought that, I pay 0.25% commission on top and a flat fee on top of that. So that's not really worth my while to trade that much. And then Dirk have a question that he emailed in. He said, how can it be that companies that are, for example, trading cheap on a QI value basis are not cheap based on value composite 1? And then also, if you take ERP5, yeah, let's just take ERP5. That's another valuation measure. I'll just add a column in with the ERP5 ratio. Where is it here? How do you get rid of this thing? Let me just see if I can. I don't know how. I always sort it, but I never unsort it by country. Anyway, let's just leave it like that. So let's say we've got QI value. We've got ERP5. These are different composite value indicators, just in case you're wondering. And now we've got to find where's value composite 1. Let's be here. The value composite 2. Let's just remove these. And if you say, for example, let's look at QI value, here's a 3. It's even cheaper based on value composite 2, and the ERP5 rank is not all that cheap. Here's a really big example. QI value is 4, value composite 2 is not that cheap, and with ERP5 the company is completely uninteresting. It's at position 19,155. And what causes these differences is the question that Frank asked, or rather that Dirk asked. And the simple reason is that these your composite indicators use different valuation metrics. For example, the difference between value composite 2 and QI value is QI value uses that liquidity ratio, looks for companies with low liquidity, and value composite 2 includes price to book. So if a company is not cheap in terms of price to book, which this is a gaming company, I think based in Hong Kong, not sure, but there you can see it's cheap based on QI value, but because it's probably not cheap in terms of price to book, its value composite 2 indicator is a lot higher than what its value composite 1 indicator is. And ERP5 rank is even different to that. ERP5, let me just look, I made a summary here. They've got ERP5 considers price to book, earnings yield, return on investment capital, and 5-year average return on invested capital. So you see there's two quality ratios included there, and that's probably why it doesn't rank well in terms of ERP5, because value composite 2 and QI value don't have those ratios. We've been going for nearly an hour. I'll just tell you, I quickly had an idea of bond alternatives in the current market. And I was looking at companies that have high cash flow, pays high dividends, and will most likely be continue paying high dividends over the next few years. And you may have moral reasons why you won't do it, but I looked at tobacco companies, and I even put in a little, where's the screen? I put a little screen together for tobacco companies. It's very simple. You can do it quickly. The only thing you really need to do is, in order to get any company in the screener, you've got to include some ratio as a first ratio, any ratio. So if you want to include all companies in the screener, just use the price index 1 month and say you want 100 to 0%. So, okay, now you've got all the companies. And then I selected all of the countries, and I only selected one sector. It is, you can see it here, food, beverage, tobacco, which obviously gives me all the tobacco companies. I put in a daily trading of 125. I didn't want to get small cannabis type companies. I think they included under tobacco. And I came up with this list. And if you sort by dividend yield, you'll see, okay, let's sort from high to low. That's more interesting. It goes from 10%, and if you buy the top 5, you have a dividend yield of up to 7, say 7 even there. Universal, I don't know too much. Vector, I think, is a smokeless tobacco company. Then you've got the classic big tobacco companies, Japan, BAT, British American Tobacco, Altria, Imperial Brands. I don't know why. Now, Philip Morris is down here, but it's still an interesting one at 6.03. That's the international part of that was, because Philip Morris was one company that broke in two. Is Altria is the US part, and Philip Morris is the international part in terms of that. Anyway, so I looked at putting a small portfolio together of this, but then I looked at the volatility, or rather the 52-week price movement, and it varies from 30% up to 51%. So, it's not like a bond at all. There's a lot of capital price movements, but you get the dividend yield. And a friend of mine said that, I discussed the investment with him, and he said he wouldn't touch it because he thinks that tobacco is a stranded asset. If you think of all these ESG type of investment rules coming into a lot of funds, and banks not even financing coal companies and things like that anymore. I don't know if these tobacco companies are going to be affected by that, or maybe a lot of disinvestment has taken place. That's why these dividend yields are so high. But you must remember that these businesses are slowly losing sales, right? They've been putting up prices to compensate for falling sales, but it's a difficult business. But they're super cash generative. I think I just looked at British American Tobacco. It's trading at 6 times free cash flow. So there is definitely something interesting here, but this is just an idea that I thought I would leave you with. Are there any other questions? If you have any other questions, please just type them into the box, and I hope to be able to answer them. Okay, doesn't look like there's any more questions. Thank you very much for attending the webinar. I didn't mean for it to go all of 50 minutes, but there were a lot of good questions, and I hope you've really found it helpful. Thanks a lot for attending.